Imagine working 30, 40, even 50 years of your life, then waking up to headlines suggesting the retirement system is under pressure again. In 2026, something unusual is happening quietly behind the scenes. It's not a crash, not a collapse, but a significant shift. Across the United States, pension funds are facing renewed strain. For millions, this matters more than any stock market headline. After the turbulence of the early 2020s, many pension systems improved. Higher interest rates helped funding ratios, markets rebounded, optimism returned. But 2026 feels different. Economic growth is slowing, markets are volatile, and commercial real estate is under stress. Here's why that matters. Public pension systems assume long-term annual returns of 6 to 7%, built into decades of modeling. But what if returns average 4 or 5% instead? That small difference compounds into billions of dollars over decades. When managing retirement promises for teachers, firefighters, police officers, and public workers, billions truly matter. Across America, pension systems manage trillions. Some states are strong with funding near 90%, while others are far lower. When funding drops, pressure builds. Governments may increase contributions, shift priorities, or alter new employee benefits. But here's what many overlook. This isn't just about markets. It's fundamentally about demographics. Baby boomers are retiring in record numbers, meaning more people drawing benefits and fewer contributing workers. When payouts accelerate, investment performance is crucial. Strong returns stabilize systems, stalled returns widen funding gaps. Now consider another factor. Many pension funds have significant exposure to commercial real estate. Remote work altered office demand. Vacancy rates are elevated, valuations adjusted, but uncertainty persists. This creates another layer of strain, not catastrophic but certainly measurable. Then there's interest rate uncertainty. If rates decline sharply, bond yields fall, reducing income from fixed income investments. If rates stay elevated, borrowing costs remain high, and economic growth may slow. Either scenario introduces complexity, and complexity is not what long-term pension models prefer. But let's pause here. Does this mean retirees are about to lose their benefits? No. Most major pension systems are still operating and paying benefits as promised. Many have made structural reforms. However, pressure in financial systems rarely appears overnight. It builds gradually. It shows up in small adjustments, reduced cost of living increases, higher contribution requirements, or longer retirement age thresholds. Private pensions face their own version of pressure. Corporate profitability cycles, market dependency, and regulatory changes all influence funding stability. The key word here is resilience. In 2008, the shock was sudden and global. In 2026, the concern is slower and structural. It's about whether long-term return assumptions remain realistic. It's about whether demographic shifts outpace investment growth. It's about whether governments can balance budgets without compromising promises. And here's something important to understand. Pension systems are designed for decades, not quarters. Short-term volatility doesn't automatically create long-term failure, but sustained underperformance can. That's why analysts are closely watching funding ratio updates, tracking state contribution levels, and monitoring asset allocation shifts. Because when systems adjust allocations, reducing equities, increasing bonds, diversifying into alternatives, it signals strategic recalibration. Not panic, but caution. For retirees, the practical question isn't, is everything collapsing? It's, how stable is the foundation if economic pressure continues? The answer depends on three variables: market performance, demographics, policy decisions. If markets stabilize and growth resumes, funding pressure could ease naturally. If volatility persists and returns remain modest, governments may face harder financial choices. And here's the deeper reality. Retirement security in America is a layered system: pensions, Social Security, personal savings, 401ks, IRAs. Pressure in one area doesn't automatically mean systemic failure, but it does mean attention is required. Because once demographic momentum shifts, it's difficult to reverse. The retirement wave is not slowing down, and that's why 2026 matters, not because it's a crisis year, but because it's a transition year. A year where assumptions are being tested, a year where funding models are being reevaluated, a year where policymakers, investors, and retirees are all watching carefully. The real story isn't fear, it's sustainability. After decades of work, retirees deserve stability. The question now isn't whether the system survives this year, it's whether it adapts effectively for the next 20. And that's the story that will define retirement security going forward.